you guys for joining us today. We're very excited about this topic. This is a topic that's brought up a lot in the industry, and so we're excited to kind of clarify some things for you guys. My name is Yvenson Bernard, and this is Ryan Skostad.
Good morning.
All right, we'll jump right into the presentation. So today we'll be talking about active versus passive investing, clarifying the old age debate. All right, so Ryan, tell us what's passive versus active investing.
Yeah. Good morning. I think first we have to clarify when we're talking about passive versus active. It's really important that it's a really broad topic, and so we're going to brush with some broad strokes today. But we're going to try to drill down a little bit. And I think the first drill down that you have to do is: are you talking about the passive active investor or the investment? The investor being the individual, are they passive active or the investment?
All right. So with our first slide, we're going to jump into the passive investor. All right. So Ryan, tell us a little bit about passive investor.
So if we start with the investor, or the person or the individual that's doing the investing, the passive investor would be somebody, if you think about who puts their investment plan into place once and then leaves it, right? They kind of, whether markets go up or down or sideways, regardless of the economy and how it's functioning, they have their investment plan in place and they don't touch it. Think of that person almost like the couch potato investor, you'd hear it called. They set it and then they forget it, and through thick and thin, they let it go.
Right. Okay. Thank you for that. Tell us about active.
Yeah. The active investor, and I'll dissect that just for a second, but the active investor, you could be hyperactive, and we hear of the day trader. And sometimes I would liken that to the hamster running in the wheel. There's a lot of activity going on sometimes, but is there any traction? Maybe not. But what I like to think of an active investor, and how we'll frame it today, is more of like a proactive investor. Doesn't mean you're necessarily active, but you're proactive. A proactive investor creates an investment policy, all right? So we have maybe a target of where we want to sit for the long run for our investment strategy. But then on each end of that target, we have ranges, kind of bounds, an upper bound and a lower bound that we're able to navigate within. And based on current situation and where we see opportunities, we try to be proactive and stay within those ranges and lean towards opportunities.
Okay. Can we be sometimes a little too active?
Yeah, absolutely. Kind of, yeah, harkening back to the hamster. That can, when you're too active, there's cost when you do make trades, inherent cost. Even if you're able to trade for free, there can be inherent costs of spreads. There's opportunity costs, and then there can also be some tax issues when you're too hyperactive.
Thank you for that.
Mm-hmm.
All right. Then, can you explain to us what an active investor is, or investment?
Yeah. So first, let's talk about the investments now. And so the differences between a passive and an active investment. I think of it as a few different things. Again, painting with broad strokes, but an active investment is going to be specific. They're going to target specific positions that they want to hold. Okay. Where a passive investment is going to be in totality. They're going to hold everything in that. And you can kind of dissect a passive investment, but they're going to hold everything. They're not going to be specific via a specific company or country or what have you. An active investment is also flexible. Make changes as time or opportunity changes, where a passive investment is static. It's going to hold again in totality, and it's not going to change. And then last thing that I would kind of clarify a difference between an active and passive investment is an active investment has a fee. There's a cost to have that specific choice and what have you, and there's a cost for having the flexibility. But a passive investment totality, it doesn't move. So there's really nominal costs and almost a kind of free investment with the active versus passive investment.
Can you tell us a tool or what is used in a passive investment?
So there's lots of different ways to build a passive investment, but sometimes they try to mimic or follow certain indices. So you can buy passive investment that deal with large company stocks or emerging market stocks or corporate bonds or what have you. And there's lots of different types of passive investments that are trying to mimic or follow a certain industry or trend of a certain type of investment.
Thank you. So, Ryan, can you tell me areas where we should be passive?
Yeah, there are areas that we do tend to lean maybe a little bit more towards the passive strategy. Where we like to lean towards passive would be in areas where we think that markets operate in an efficient manner. When I say efficient, that means that they tend to move in a way where the price that you're paying or buying or selling a stock for is actually what is accepted in the market. And so if there's an area where markets are efficient, we tend to be a little bit more passive and save some cost. And so we'd liken that to large company US stocks, for instance. It's really hard for somebody to feel like they have more knowledge than the average person on a large company US stock. And so we think those markets are very efficient. Also in times of tranquility, when everything is doing well, it's really hard for an active manager to outperform a passive strategy because everything's moving up together. So in times of tranquility, we'll also lean a little bit more passive.
So during these times right now, what are we using?
Yeah, so and if you want to kind of think what times will we not do a passive strategy, in times of volatility. When there's a lot of volatility and markets are maybe in distress, that might be a time where we would to lean towards the active side of the strategy, right? We don't want to own everything because not everything is moving in lockstep together, right? There's definitely some winners and some losers in times of volatility, and we want to be more specific with our investments, so we'll actually lean active. And then there's also areas of the investment universe where we will lean active, and those are markets that are inefficient. So when you think of markets that are inefficient, think of, the easiest one that comes to mind would be emerging market stocks. The information for emerging markets. So there are ways that you can, you do have access to information potentially more than just the general person. And so that would be an area where we would definitely lean active.
Awesome. What about areas to be active?
Just hit it. Yeah, emerging market stocks, international, things like that. Micro company stocks, things where the information is less public available. Those markets are going to be a little bit less efficient. So that's where we lean.
Tell us a little bit about Capsules Process.
Yeah, so there's one area where we really never like to go passive, and really important because the fund flows that we see today there is a lot of money moving towards a couple asset classes that are passive that we really like to avoid, and that would be passive fixed income, at least certain areas of passive fixed income. So just to give you a kind of a 30,000-foot view, how a stock index is created is if I buy the S&P 500, the highest weighted or the highest market cap companies I buy more of when I buy the S&P 500. So if I want to put money in the S&P 500 index fund, more of my money goes towards Microsoft and Apple and Amazon than it does towards companies like PayPal and ServiceNow, et cetera, right? So your money when you buy an index fund goes towards the more market weighted companies typically. Now, how a fixed income passive investment is created is the companies that have the most debt outstanding make up more of the index. And so if you buy a passive index fund, you're actually buying more of the highly leveraged companies, which is probably not what most people are trying to do when they're buying a fixed income investment. They're not trying to buy the most leveraged company. They're just trying to get a fixed income allocation, not necessarily be really risky and buy higher levered companies. So that's an area, if we're going to do passive fixed income investing, it's usually only going to be in very safe, highly rated fixed income type passive investments, not trying to buy highly levered corporate passive fixed income.
All right, thank you for the explanation.
Yeah, sorry to bring you back.
No, you're good. That's good. We'll jump right into the capsules process. What is our process during these times?
So our process, what we like to do is we want to seek out the best risk-adjusted return net of fees. And net of fees is the big critical key there, right? The best risk-adjusted return net of fees. And so what that means is we take fees into account. And if we think we can get the best risk-adjusted return with the passive strategy, then we're going to do that. But if we think we can get the best risk-adjusted return net of fees, but that fee is a little higher, but our return can be higher risk-adjusted, then we're going to do that. And so we're going to marry or blend a combination of passive strategies and active strategies into a portfolio based on where we think we can get the best risk-adjusted return. So we're utilizing both in our strategies, and we sometimes will lean a little bit more active and sometimes lean a little bit more passive, depending on market environment.
All right. Thank you for that. That's awesome. Great stuff. We'll open it up to Q&As. We'll get your answers here in a little bit. Questions?
One question. Does tax efficiency come into play in your process?
Absolutely.
Yeah, definitely. So there are cases where typically a passive investment, just for a quick review, a passive investment typically is going to be more tax efficient because there's not as much movement within the portfolio, right? It stays fairly static. Where an active managed fund will have more movement. There will be some changeover of funds. And so that can create some tax implications if you're holding an investment in a taxable type of fund. So we will lean the portfolio. If you're in a taxable type of account, we're going to lean the portfolio more towards passive investments to save on taxes. Where if it's in an IRA or a Roth or a tax deferred type of an account, then we're ambivalent, and passive or active doesn't matter. And we're going to take the best risk adjusted return as much as possible. Good question.
Perfect. And it looks like we have a few more questions that were submitted. One of the questions is there a good mix of active versus passive?
Yeah, I think it would depend on the portfolio, right? If you have almost all of your assets in taxable investments, then we're going to have a higher percentage of passive than we would active relative to the person. If they had all of their investments in tax deferred, they might have more of an active percentage weighting simply because taxes don't play a part. So it really depends on the portfolio makeup and how much is in taxable versus non-taxable to figure out what that blend could be. Any more questions? Is that it?
Yeah.
All right.
We would appreciate questions or feedback if you guys have any. If not, we can wrap up the meeting. Looks like another one came in. Why are some funds expensive?
Yeah, good question. So the harder it is for a fund to do their job, the more expensive it gets, I guess is the easiest way I'd say that. So if I'm managing a government bond fund, there isn't a lot of research I have to do on government bonds. I'm buying a bond of United States Treasuries, and I don't have to worry necessarily about the credit quality. And so there's not a lot of research that has to be done. A U.S. government bond fund can be very cheap. But if I want to buy an emerging frontier small cap stock fund, and I'm now having to do research on companies in the Middle East and some African nations and maybe South America, and we're trying to get in and kick the tires and understand the strength or the quality of these individual companies in some remote areas, that's going to be a little bit more expensive. That's going to take a lot more research, a lot more feet on the ground. And so, I'm giving you one spectrum on the very safe to a very expensive fund and everywhere in between. The cost difference is going to be on the access to research and the time and intensiveness that how many people they have to have on a team to make that strategy work.
Thank you, Ryan, for that.
Awesome.
Yeah.
Alrighty, well, I think that we are going to wrap up the meeting. Thank you so much for joining us, you guys, and I hope you have a great rest of your day.